This is MacroVoices with hedge fund manager Eric Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Let's move on to our own post-game chart book. Listeners, you'll find the download link in your Research Roundup email. If you don't have a Research Roundup email, it means you're not yet registered at MacroVoices.com. Just go to the website, MacroVoices.com, click the red button on the homepage that says Looking for the Downloads. Page 2, S&P 500 Continuous Futures Chart. What do we got going on here?
Well, Erica, I want to really put in context the three major indices, the S&P, Nasdaq, and the Russell, in terms of how they have relatively performed. What was interesting is that we did have a really strong year-end surge to a fresh new 52-week high on the S&P 500. And it really does look actually quite bullish just from the charts. Even with this recent pullback on the reactions to FOMC, it's been just about a 50% retracement of the prior rise. Still, the previous highs can act as support, can still hold above its moving averages. And it's hard to make an argument that just on the chart on the surface looks bearish. But when we go to page 3 and look at the Nasdaq, it's interesting to start seeing where some of these divergences or different price actions occurring. During this whole sequence, the Nasdaq failed to actually make a higher high when the S&P did. And more importantly, it was very quick to give back the entire gain and come right back to the bottom of its trade range that it's been in through November and December. And what we continue to see is now a larger amount of these FANG stocks are starting to actually break down and deteriorate in price. There are a few that are still holding up, but generally these are like the big market cap behemoths that are driving these indices. And the bigger question is, if we see that they continue to underperform and show some sort of distribution or basically simply a lack of participation, can the S&P 500 run higher? And so it's an interesting way to kind of put in context. And I think if we look under the surface, I think it's going to be really important to see whether or not the breadth can widen enough to compensate or whether the FANG stocks will dominate this trend. But on page 4, where I have the Russell 2000, the small cap index, it looks even more ominous, because while we had a very bullish breakout in October into November or early November, that Russell gave back the entire gain. And during this period where the Nasdaq and S&P went to press to new highs or attempt to, the Russell was barely able to make any meaningful bounce off of its lows. It really shows that this continues to be driven by only the largest cap stocks that are driving these indices, and the breadth is still relatively poor. Now, interesting thing that will be something to watch is, based upon your narrative that you spoke about in the market wrap, I think that if, in fact, the Omicron does end up actually kind of crowding out the COVID fears and things reopen, would we have a rotation where things like those mega cap stocks sell, but the small caps suddenly start to get money flow as the real economy is starting to come back into action? There's certainly no technical sign of that, but it's certainly going to be interesting to see whether or not that is something that emerges throughout the year.
On page 5, you've got the dollar-yen cross. What's up there?
Well, it's interesting because this is the one part where the U.S. dollar is potentially showing signs of further bullishness, while the euro, which is the large market cap weighting in the dollar index, continues to pin the dollar index. What's interesting is that U.S. dollar legitimately broke out against the Japanese yen, and looks like we might be even heading toward 117 or higher on this move. And it'll be really interesting to see when you kind of break down so many of the major currency crosses. The US dollar looks like it's in pretty good shape right across the board against each pairing. While we're in that trade range, it really does feel like the dollar has a shot for further upside strength. Moving on, though, Eric, to page 6, here's that chart of crude oil, and you were just talking about that in the market wrap, and I just thought we'd just put some visual to this. What's interesting is that the real breakout to me was when we were able to beat that $73 level. That was where there were some key hurdles, and it's been nothing but upside since then. The one thing that I'll be watching, though, here on crude is that often as you go and test a previous high, at minimum, it tends to stall the price action. And so as we, even though I'm very bullish about this trend, we are slowly approaching within dollars of testing a key overhead resistance. It'll be interesting to see whether that spurs some selling, and more importantly, if the pattern of buying dips continues when we do inevitably get some of that like pause and mean reversion occurring. One way or another, it is a bullish chart, just some short-term resistance coming up.
Patrick, I agree with all of your analysis. I was fortunate enough to be able to use Monday's revisit of the 100-day continuation moving average to get back into half of my position at only a little bit above where I got out of it, thinking that the Omicron panic might scare the market lower, which turned out not to happen. And I'm going to be looking at any more dips to get into what remains of the position that I need to scale back into, having missed some significant upside here. So I do think there's probably another dip coming, but I also think that we're headed towards $100 here, and substantially higher than that if we don't see some significant investment in energy, which I don't see happening. So I think prices are headed much higher longer term, but for now we're maybe a little bit overdone on the upside. Let's move on, though, to page 7, where we've got gold futures. Boy, it looks like we're kind of reversing to the downside, getting a little bit ugly here.
Right. And I mean, I think that right now, when we go to the further pages, we'll see that interest rates are rising, which typically does have some drag. Usually it's the real rates that are being influenced the most on it. But certainly this FOMC reaction took all the wind out of the sails of gold. I continue to think that 1,800 round number, where all those moving averages is truly the arbiter of the new trend. If we see, like you were suggesting, any sustained price action that is failing to get back above 1,800 and just consolidating there, then while I'm not necessarily bearish gold, there isn't much stopping gold from trading to the bottom end of its trade ranges and revisiting 1,750 on the downside while it gets stuck in the mud waiting for the window for where it can meaningfully rally. One way or another, it'll be important to watch this week. This is the first break back down below 1,800. Let's see if it sticks.
Well, I agree, Patrick, and I think it's important to acknowledge here that, the prognosis for gold, the reason that a lot of people were bullish gold is we thought that negative interest rates were coming and that there would be debasement of fiat currency. Well, it's all happening. We've got deeply negative real interest rates, and that was the big thing everybody thought was going to ignite gold to the upside. And what we've seen is that other inflation trades like copper and oil have performed much, much better. So I think it's time to acknowledge here that gold's not doing what most people expected it to do. Maybe it's just taking its time and not quite there yet, but boy, it sure is taking its time. In any event, let's move on to lumber futures. Boy, they're recovering pretty substantially. A lot of people said that the big run-up in lumber futures was all about supply chains and, it was a one-time thing. It's all going to be over. We're never going to see it again. Well, look what's happening again.
Unbelievable. Obviously we had this parabolic blow-off back in the second quarter of 2021 as lumber hit 1,700 plus on the upside. And then we had an extraordinarily deep bear market correction that basically wiped out the entire advance in its entirety, going right back down to 2020 lows, near 500. Usually, when you see that type of a reversal, the price of something in a bear market would stay and consolidate along its lows for extended periods of time. And I find it actually quite surprising how quickly lumber has turned right back up and seems to be starting a brand new parabolic move, like a deja vu of what happened last year. It'll be really interesting to see whether the bulls continue to gain momentum and whether we start seeing limit up days again in the lumber markets. But boy, has this been one of the stronger trends that's been in the commodity space.
And to think that the lumber market bottomed in August, right in the middle of home building season. Not exactly what I would have expected. Let's move on to pages 9, 10, and 11, Patrick, where we're taking a look at yields on treasuries, on investment grade, and on junk.
That's right. You know, the interesting part about this move on the 10-year Treasury yields was that it was, while certainly the trend continued in the post-FOMC meeting minutes, what's interesting is the move started well before those days before. And we're really seeing suddenly Treasury bond markets starting to legitimately break down. And I wonder whether or not it may be tied to the move in the U.S. dollar against the yen as well, as it could be flows that are influenced from there. But one way or another, these 10-year Treasury yields are trying to break out to above those 2021 highs. But what's interesting is that this is no longer just Treasury yields. We're starting to see a legitimate weakness developing in corporates as well. I have, like you were saying, on page 10, the investment grade corporate bond ETF LQD. And what's interesting is that there's been very distinct weakness in corporate bonds all last year. And here we have a breakdown below the fourth quarter lows. And it really looks almost like the bond breakdown in corporates is just accelerating. Even when we look at the junk bond market, which usually has shorter duration on page 11, a very distinct rollover failure to even legitimately retest its previous highs, and really makes it vulnerable for further weakness. And what's interesting is sometimes we've seen bond market moves lead stock market moves. And I think that with the fact that we're seeing these breakdowns, I wonder whether or not this is a canary in the coal mine to some potential equity weakness going into February. Sometimes there's a lag in this, but if we continue to see weakness in this market, it'll certainly be one of the things to watch, whether that translates to selling in broader equities.
Folks, if you enjoy Patrick's chart decks, be sure to check out bigpicturetrading.com, where a free trial will get you a Patrick Ceresna chart deck every single day of the week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.